I heard through the grapevine that test one marks are starting to trickle out. All right, so welcome to CTA officially. All right, because some of you got interesting marks. I won't say bad marks. Some of you got interesting marks. Some of you got great marks. So welcome to CTA, guys. It's going to be a year. So you need to decide. Do you focus on what you got or do you try and build on what you've got? Okay. So if I were to tell you my experience after getting my first test, I got 17, 19, I think my highest was 49, 27 and 49, right? And I had to make a decision, right? Coming from undergrad where you cream it, you're like always at the top of the class, and all of a sudden you get this, thinking to yourself, did they swap numbers around? Like 1-7 and, you know? Okay, guys, it's a shock to the system, but you need to be cognizant of the fact that some people have gone through this and they've made it to the other side. Okay, by the time I got to test 3, because I forgot all about test 1, I said I'll continue doing what I do, what I've always done from undergrad, and by the time I got to test 3, I was good. Time I got to the exam, I was perfect. So it's either you focus on the fact that you got 17% and you try and start chopping and changing things around. Guys, it will not work. Okay, just focus on getting the information into your head. You're only 3 months or 2 months into this, so you need to, it's a marathon. Okay, so people might look like they're ahead of you, but just keep at it. Okay, you'll be good. All right, but if you start focusing on the fact that you got 17%, your confidence is knocked, then you will start panicking into the next exam. Don't panic, as long as your information is in there. Okay, please do not waste a lot of time reading those thick books. Make summaries for yourselves. You do not have time, unless you're a full-time student, right? And I also say full-time students don't even have enough time. So for you part-timers, it's even worse. So I will say, guys, get good summaries. Don't spend a lot of time there. Spend a lot of time trying to apply. This is applied accounting, applied tax. So you need to spend more time applying than more time studying. You studied this stuff from first year to third year. So now it's all about applying all that information. Okay, so don't get worried about the 10% and the 15%. Okay, you need to start applying. Is that cool? All right, because I know round about this time I start getting the emails. I know I start getting the emails. Am I supposed to be even doing this? Yes, you are. And you're in right company. And you are in right company, because a lot of you will have struggled, but that's where you are, and make the best of it. I know some of you used to get 70s in tax and 80s. So just keep at it. Just keep at it. All right, let's get into this week's work. So I wanted to look at the tests. So test 2, 2018 test 2. So that's level 1, level 2. There's also another question 3 that I want to do. And then I'll also look at question 7 and question 16 briefly. Is that cool? Right, unfortunately, I lost 4 hours last week. Right, I had a throat infection. Fortunately, I lost 4 hours, so I cannot do that painting with you guys today, because I need to be out of your hair by 11:30. Is that cool? Right, but in the full-time space, I did not lose any time, so we are still going ahead with the recordings. Okay, so I'll record and then I'll put that up online. Is that cool? Right, so you will see how we will tag in the full-time class. Cool. All right. So question number 7, part 2, right? Part 1, guys, I'm not looking at part 1 because I'm assuming by now you guys have practiced a lot when it comes to disposal of assets. And you'll see test 2, 2018 had a lot of disposal of assets. So if you haven't practiced, go home, practice, right? But my assumption is you guys have looked at disposals. So during 2019, an annuity was paid to Mrs. Salad Dressing, a former employee who was instrumental in helping to set up the business. So she decided to be a stay-at-home mom after giving birth to twins. Right, that 5,000 Rand that is paid, it's paid as a what? Annuity. What section are you looking at here? Annuities. When can a company deduct when it pays annuities? Old age, ill health, and death. So in this case, old age, ill health, death. Okay, so therefore that amount is not deductible. Okay, registered a new patent for a newly designed kitchen. So registration costs 2,800. Registration, patent, intangible assets, what percent? 100%. Entered into a 12-month learnership on the 1st of July. Right, so we've got a year end, and that year end is the 30th of September. So we're looking at the 30th of September, 2019. The year began on the 1st of October, 2018. Entered into this learnership on the 1st of July, 2018. So July, August, September, 3 months in the previous period. So therefore it ran for 9/12 in the current year because it's a 12-month, right? Okay, 12 months. NQF level 5, not disabled. What's that amount there? 40,000 Rand. Okay, and then completion deduction. So that's for running the contract, and your completion deduction will be 40,000 times 1. Okay, guys. Please don't use the handwritten notes as decorations. Read them. Get all that knowledge into your brain. Only summarize that into 41 pages. Okay, your silk is 1,300 pages, so you should be thanking me for that. Okay, cool. All right, and then we've got an assessed capital loss. Guys, when you have an assessed capital loss, your assessed capital loss goes to your aggregate capital gain calculation. Aggregate capital gain calculation minus prior year losses, multiply that by 80%, and that then goes into your taxable income calculation. Does that make sense? Okay, so when you're dealing with your capital gain, so from that disposal that I skipped, you will calculate a capital gain. After calculating that capital gain, you will have an aggregate gain. After you determine your aggregate gain, only then do you take that 1,500, multiply that by 80%, and that number then goes into your taxable income calculation. Do you remember this from test 1? Okay? Only the taxable gain goes into your taxable income calculation. Your assessed loss does not go directly into that calculation. Cool. All right, I wanted to look at part B. All right, the reason I wanted to look at part B, because I did it in the full-time class, did see a few students struggle, so I then thought, let me just do it with you guys as well. Right, Mega Chef is one of the main sponsors of a reality cooking show for a 3-month period. Cooking show for a 3-month period. Sponsorship agreement. Sponsorship. So Mega Chef is one of the main sponsors. The sponsorship agreement, and we get some more information here, for which Mega Chef had to pay its legal advisors 3,500 to draw up, stated the following, and those are the terms of that sponsorship agreement. Okay, so let's start thinking here. Right, we've got a sponsorship. Cool. So let's think about your sponsorship. What's a sponsorship? What do you get from a sponsorship? Advertising, right? So what's the expectation there? Increase in sales. Okay, cool. Now let's look at the legal fees. 3,500 in legal fees were paid to draw up this sponsorship agreement. Now, part of this question is to discuss those legal fees. What's your starting point? What would your starting point be? I know I do not write a lot of theory questions, okay, because UNISA doesn't care about your English, by the way. Okay, they don't care about your English, right? All they care about, okay, so I know a lot of students love this. Then another paragraph. Then another paragraph. How many of you write like that in the exam? Okay, if you do this, okay, the marker is not looking at this. It's too much words to read because I've got too many scripts to mark. Most of the times they're looking for key and specific words, right, which I will show you as we go through this question. So where are you starting? What's your starting point? How many of you have seen this when you request your script from UNISA? Have you seen that? Okay. If you haven't seen it, good for you, but if you have, you know what I'm talking about. All right. So, what's your starting point? Okay, which is where a lot of us are getting it wrong. We always try and, short of saying my name is, right? You need to think of the fact that you're doing tax. What in tax are you doing? Income tax. What particular in income tax are you doing? Not necessarily companies, because it doesn't matter whether it's a company or a natural person. Income tax is income tax. Revenue, no. You've even gone further. You've lost a lot of marks there. What's the framework? What's the framework of your income tax? Income, less deductions, add taxable gains. Is this an income discussion? Is it a deduction discussion? Okay, so that's where you need to start, dealing with the deduction discussion. What are the three components that make up your deduction discussion? No? What are the three components that make up your deductions? General, specific, and prohibited. A lot of you just go straight for the jugular. You lose a lot of marks. Short of writing your name, guys, this is what you need to do. Go to the beginning. I am doing tax. Income tax. Taxable income, deductions. And I will start by saying I'm dealing with deductions. Three types of deductions that I'm dealing with here: general, specific, or prohibited. What's the hierarchy that I always go for? What do I discuss first? What do I do first? You cannot discuss general first. You always have to discuss that. I've even written that in your handwritten notes, by the way. In those decorations that you guys parade around. Okay, first, discuss your specific deduction. Then you go and discuss your general deduction. Then you only consider your prohibited deduction. So that's first, second, and third. Okay, in your handwritten notes, you will see from test 1, I've given you that framework, I think, 2 times now. So how many of you actually go and start there? You have to go and start there and say, I need to consider what type of deduction this is. I've got 3 types of deductions that I can consider: specific, general, or prohibited. You don't need to do that. You can do that in bullet point. because this is what they want to see, your thought process. What are you discussing first? From there, what will you discuss next? Make sense? Okay, so as someone that marks exams, this is what I look for. Have they considered that? So I quickly scan through. I'm not going to read all that. Okay, I scan through looking for those specific words. If they are not existent, then I don't give you a mark. Okay, even if you write like Shakespeare, I'm not going to give you a single mark. So I'm scanning for this. Does that make sense? Okay, so specific, general, or prohibited. Let's go back to our legal fees. Legal fees. What are you looking at? Specific or general? Specific. Right, so we're looking at specific. Which specific are we looking at? Section 11C, which deals with your legal fees. Did anyone bring their handwritten notes? Go to your legal fees. I think it's around page 12. 11. Actually, before you even get to legal fees, right, there's section 23B, which basically says you can only claim one as a deduction. Right, because sometimes you can meet your specific and also your general. So you'll have to choose one. And that choice is first specific, then general. Does that make sense? And UNISA loves this, 23B. They love it. It's always there in your mark plan. Make sense? So number one is my starting point. 3 types of deductions I'll consider, right? Specific, general, then prohibited, right? If I can claim in more than one section, I'll only claim in one. Then I'll go and then deal with my section 11 legal fees, right? Section 11 legal fees. Number one, I need a prescribed cost. Right, so I need a prescribed cost. Then you start looking at those requirements. Prescribed cost. I need a prescribed cost. Prescribed cost, right? Have we paid a lawyer? Yes. This needs to be action of law. Claim, dispute. Right? It needs to be an action of law. Claim or dispute. Is anyone in dispute with me here? Am I disputing with anyone in this sponsorship agreement? Am I claiming anything from anyone here? Am I suing anyone here? Did I sue anyone? Did this happen during trade? Right? Is this capital or revenue in nature? Right? Remember, when you're looking at capital in nature, you're looking at whether there's an enduring benefit that will arise. Will there be an enduring benefit that will arise? Okay, enduring benefit, think about this. This sponsorship agreement is for how many months? 3 months. I cannot see an enduring benefit. Okay, if it was longer than 12 months, then potentially I will see an enduring benefit. Okay, but it does not create an enduring benefit. Tell me that one advert on a street light will have an enduring benefit. Tomorrow it's off, and you see Cyril Ramaphosa's face there. Just joking with you guys. Okay, so capital in nature, right? Underlying transaction deductible, underlying transaction taxable. Okay, I've already discounted this. Cannot be a Section 11C. So if it cannot be a Section 11C, then where do I go to next? General deduction formula. Then I'll go to my general deduction formula. Looking at my general deduction formula, section 11A, trade, we are trading, expenditure or loss. Is there expenditure or loss? Yes, 3,500. Actually incurred. What's the key thing for actually incurred? What's the key thing that we're looking for when you're looking at actually incurred? Sorry? Okay, not necessarily paid, not that important here. Actually incurred. Actually incurred. Okay, I'm getting more and more convinced that you guys use those as decorations. Legal obligation. These are the key words that your markers are looking for. Legal obligation. Do you have a legal obligation? Yes. In the production of income. What are the key words that I'm looking for there? There are two that I'm looking for here. Okay, that's the second one. What are the two things that I'm looking for? Okay, what are the two things, guys, that I'm looking for there? I've given them to you in the handwritten notes. I've said them a million times. Why? Why? What action gave rise to the expenditure? Number two, is that closely connected to the business? Two things. Why? Closely connected. Compare that with that. When I do this, the examiner is looking at those keywords. They don't even care what I say after those keywords. They just put a tick, put a tick, put a tick. Whether my English is good or bad, they're looking just for that. Closely connected. Why? Legal obligation, action of law, dispute. Does this make sense, guys? So there's no need for you to do this. And the other thing about examiners is they hate doing this. Does that make sense? They hate giving marks like that, 1, 2, 3. They like giving marks like this. Like, oh, you say this point, then you say that point, then you say that point. Does that make sense? Okay, so you need to learn how to identify those keywords in a question. Is this closely connected? Closely connected, inevitable, concomitant of doing business, for example, right? This will increase my sales. That agreement will increase my sales. Does that make sense? Okay, those are the things that they're looking for. Here they're looking for the PE electric tramway case, for example. Inevitable concomitant, they're looking for the Joffe case, and they'll give you a bonus mark for that. Make sense? Okay? And whether it's capital or revenue in nature, what are they looking for? Capital or revenue in nature? I have already said it a few minutes ago. Enduring benefit. Will this create an enduring benefit? It's only for 3 months, will not create an enduring benefit. Those are the key words they're looking for. I don't need to write paragraphs. All I need to write are those bullet points with those key points. Does that make sense? And I've given to you in bullet point form in your handwritten notes. So all you have to do is match each point to the key point that arises from there. Does that make sense? And I've also given you court cases in your handwritten notes. And that, guys, gives you 12 marks. Any questions? Are we good? Okay. I have said this a lot of times, but just wanted to show you that you do not need to write it like this. Please don't write it like this. Okay? Make it easier for the markers, right? Remove any doubt that you know your stuff. Okay? Because if you break it down in bullet point like this, it will take you a shorter period of time to write it down, and you're highlighting to them, showing to them that you know what you're doing. Cool. So next time you see yourself writing a paragraph, this is not auditing, this is tax. Cool. So let's continue to the next point. MegaChef will supply all the kitchenware that's required by the contestants during the cooking competition. Ownership of the kitchenware is retained by MegaChef. So who is MegaChef? If you guys did read who MegaChef was, MegaChef is a resident company, manufactures and sells stainless steel kitchenware. So what's kitchenware to them? Trading stock. Okay, so now they're moving this trading stock to what? They're moving that trading stock to what? They will supply and they will retain the ownership. They're moving that to what? Fixed asset. Do you guys remember this from the previous class where we moved from trading stock to a fixed asset? Look at page 15, 16 in your handwritten notes. Moving from trading stock to a fixed asset. Okay, so there are two types that you need to distinguish. One is not manufactured, which you find in, on page number 15. Not manufactured trading stock. That's the one that you find on page 15. So when you move from trading stock to fixed asset, number one, this is what you will do. Recoupment at market value of your trading stock. So you deemed to have sold your trading stock at market value. Make sense? Okay. And then number two, you are deemed to have purchased an asset. So therefore, the base cost of your asset will equal to the market value. And from there going forward, you will then depreciate this asset. Does that make sense? So the trading stock is deemed to have been sold at market value. Now it's a fixed asset. That fixed asset, the base cost will equal to the market value, and thereafter you're going to depreciate this asset. Now this is when the stock is not manufactured. Was the stock manufactured or not manufactured? In our question, it was manufactured. So they had to specifically tell you that they bought the stock, then they used it as a fixed asset. But in my case, I am told that they manufacture and sell. So therefore, this is manufactured trading stock. So if it's manufactured trading stock, go to the next page, page 16. Right, page 16, the bottom of page 16, right, the second last point there on page 16, you will see that if we move from trading stock to fixed asset, and this is manufactured, we will continue treating this as what? Trading stock. So it will still continue having an opening stock deduction. It will continue having a closing stock adjustment. So I'll continue treating it like my trading stock. Yes, I'm using it as a fixed asset, but it will be included in my opening stock, included in my closing stock. Make sense? So I'll have an opening stock deduction, closing stock recoupment in the year that I sell it. In the year that I sell it, this is what I'll do. I'll include income, right, in terms of paragraph J, capital A, of any amount that I collect. Does that make sense? In the year that I sell it, I'll include income, but think about this one that is not manufactured. In the year that you sell it, what do you do? The one that's not manufactured, you will have CGT, recoupment, or scrapping loss. Can you guys see the difference there? Okay, so for this one here, I just continue treating it like my asset, my trading stock. This one here will be treated like a normal asset with depreciation, CGT, recoupment, and a scrapping loss. Okay, so therefore going back to Mega Chef, looking at Mega Chef, opening stock deduction, closing stock recoupment, when you ultimately sell it, then you will include into paragraph, into taxable income through paragraph JA of the gross income definition, specific inclusion, sorry. Yeah. Okay, you can just check if I'm not lying to you by going to the handwritten notes, page 6 or 7. You'll see one of the specific inclusions, manufactured trading stock that is used as a fixed asset. When sold, that's specifically included into gross income. What page is that? 6. Make sense, guys? Okay, cool. All right, so we've dealt with this here. Okay, so the logo and contact details will be televised, so they're basically telling us that you'll get publicity from this, which we've already dealt with, right? All kitchenware used will be returned at the end of the competition, after which it will be donated. Okay, so when it's returned to Mega Chef and donated, what are the implications of donation? Remember, we were treating it as opening stock and what? Closing stock. So when we donate this, donated what? Trading stock. Page 16 of your handwritten notes. Stock given to whom? Public benefit organization without a section 18. A certificate we will recoup at what? Market value. So therefore recoupment will be made at market value. So you will add into taxable income the market value of that donation. Did we get a section 18A? Did I read this incorrectly? It's not a PBO. So guys, if it's not a PBO, you can then claim something else. What can you claim? Sponsored by. Have you seen that? Sponsored by. Won't you say that when you give away that stuff? Sponsored by. So you will get a section 11A marketing deduction. What's the reason for giving it away? Right? Most of the times, you sponsor, you will put an advert somewhere saying, I donated all my cookware. Okay? You'll still deduct this at market value. Yeah. So you will get a marketing deduction for that amount. On the 1st of October, kitchenware with a cost of 100 was made available to the organizers of the competition. So this is from day 1. right? So from day one, they will do this. Opening stock already includes 100,000 rand. Closing stock will be 100,000. So they'll continue doing this. Opening stock 100, closing stock 100. Opening stock 100, closing stock 100, up until that competition is finished. Make sense? Okay. The 31st of January, after the reality show was recorded, they discovered that kitchenware with a cost of 3,500 had disappeared, and that kitchenware with a cost of 2,250 had been damaged beyond repair, and they could not donate this. The damaged kitchenware was sold as scrap for 500 rand. So this is a sale, right? Sale 500 rand goes into your taxable income calculation. Remaining kitchenware valued at 55,000 rand, recoupment at 55,000 rand, then you can claim your section 11A marketing deduction for 55,000 rand. Okay, these were the only donations made by Mega Chef. So what other implications are we thinking of here? It's now a given because you've gone through test one. Donations tax, correct. So there will be a donations tax implication, 55,000 rand. Can we claim the first 10,000 rand? It's only on casual gifts, birthday presents, wedding presents, not this. Multiply that by 20%, and that's the donations tax paid. Okay, that was the whole reason for going through test one. Teach you all the different taxes that will have an implication on one transaction. Okay, guys, this damaged stock and the stock that disappeared already has been taken into account in your opening stock deduction. So when you recoup back 55,000, you've already taken into account the fact that some stock is damaged or stolen. Is that cool? Unless if they did not specifically tell you that, then you will claim expenditure or what? Loss actually incurred in the year of assessment in the production of income. Okay, however, it's already been included there. Any questions? Yep. Okay, 55,500. Which 500? Sorry? Guys, the scrap, did I not include it? I have. I already did. Sales. Right, sales, because that's a sale. Total amount in cash or otherwise received or accrued in the year of assessment, not of a capital nature. When you sell your trading stock, you will include that into your taxable income calculation. Okay, that's not a donation because you have received cash for it. Remember, that was sold to a scrapping place. Scrap metal. So that's a sale. Oh, so, and this amount was then donated to an orphanage. Okay, I understand, yes. 500, multiply that by 20%, correct. Okay, question number 16. Right, question number 16. I'm not going to do the entire question. I would like to cherry pick some of the difficult things. Okay, so for this one, registration fee paid for a trademark. When you're registering a trademark, what can you claim? 100%, 0%? 100%. Right, they bought a second-hand manufacturing machine from an independent party for 2,150,000. That's equal to the market value. How do you value your asset? Let's go back to the value of your asset, or the cost of your asset, sorry. What's the cost of your asset? Cost of your asset, guys. Lower of what? Cost or market value. Do you guys remember this? Okay, what do we know about market value? What do we know about market value? You guys remember this? Okay. So they bought a second-hand manufacturing machine from an independent party for 2.15 million rand. Okay. So therefore you need to remove the VAT from your market value. However, in your TUT letter, I haven't seen a question where you remove the VAT. So can I concoct my own question here? Is that cool? All right, so you bought this asset for 2.3 million rand. Okay, and you have a market value of 2.15 million rand. Cool. So what is the cost of your asset? Times 100 over 115. How much is that? $2 million, right? So the cost of your asset is 2 million rand. Are you guys comfortable with that? Okay, now let's look at your market value. Market value is 2.150000. Multiply that by what? 100 over 115? It's not correct. Cannot do that. No, it includes VAT, because we did say that. Includes VAT. And how do you take away that VAT? How do you take out that VAT? Times 100 over 115? Did you not remove VAT by saying 2.3 times 100 over 115? It was cost. Okay? So when you're taking out the VAT from your market value, always take out the VAT that you claim from SARS. Does that make sense? So therefore, how much VAT did I actually claim from SARS? How much VAT did I actually claim from SARS? Obviously, 300,000. So 2.15 minus 300,000, that will be the market value of that asset. You do not take the market value and multiply it by 100 over 115. Okay, I did say this in the first lecture, but I know that it did not make sense because I didn't have an example. Is that cool? All right, let's look at the next question. 2 forklifts from the F moving range were taken from trading stock on the 1st of March, used in the factory to move heavy materials. Okay, so who is this company? It's a company that does what? Manufactures earth-moving equipment. So the earth-moving equipment to them is what? Trading stock. So this manufactured stock has been moved from stock to what? Fixed asset. So what will we continue doing here? Treating it as trading stock. So therefore I will have an opening stock deduction of 80,000. I will have a closing stock recoupment of 80,000. Every single year that I have this trading stock, opening stock, closing stock, opening stock, closing stock. In the year that I sell it, all the proceeds are included into taxable income. Does that make sense? All right. Point number 4. Since the 1st of April 2016, the company leased a delivery vehicle with a cost price of 780 from a non-connected party for 25,000 Rand per month. Agreement stated that the earth-moving equipment will be permitted to continue using the delivery truck at the end of the 3-year period for a rental amount of 3,000 Rand per month. For 3,000 Rand per month. What type of transaction is this? Abandoned lease. Okay, so let's look at during the period when it's a lease. Right, so since the 1st of April 2016, all right, so this is a 3-year lease agreement. Let's just quickly check our year end here. What's our year end? December year end 2019. So, April 16, April 17, April 18, April 19. That's 3 years, right? My year end begins on the 1st of Jan 19. It ends on the 31st of December 19. So that's my period of assessment, 1st of Jan to the 31st of December. And this here represents the remaining portion of that lease. Is that cool? Can I deal with the implications of that lease here? Can I deal with those implications? Because previous week, I think few people struggled with this. So, in April 2016, in April 2016, what are the implications? Accounting perspective, debit, asset, 700 and what? Is it 780? Right, this is a finance lease. Let's assume it's a finance lease. Debit what? Input tax, 780, multiply that by what? 14%. Credit what? Lease liability. Credit your lease liability. That will be the 780 times 1.14. Are you guys comfortable with this? So that's what you did from an accounting perspective. But what do we do from a tax perspective? From an income tax perspective? What do we do? Okay. Guys still need to remember we're doing tax here. Remember we're doing tax? Okay. So we're doing tax. What particular in tax are we looking at? Income tax, right? Income tax. What in income tax are we looking at here? Deductions. What types of deductions do I have? Specific, general, and prohibited. Right, so which type am I looking at here? Specific. Let's deal with specific first. Can I claim a specific deduction on my finance lease? The only specific deduction I am thinking of here is 11E, 12C, or 12, capital E. Can I claim those deductions, guys? I'm trying to show you how to answer this in a theoretical way, because they might ask you, discuss this without calculations. Can I claim any of those? Why? no ownership. No ownership. Okay, so therefore you cannot claim any of those allowances there. Okay, why don't we have an ownership? Because your ICA excludes what? Finance leases. What's an ICA? Installment Credit Agreement. Everyone comfortable with this? So if I cannot claim those sections there, what section can I claim? Remember, I've got three types of deductions. Specific, nothing from a specific perspective. What next can I claim? General. So therefore, I have to go to my general deduction formula. Is this expenditure? Yes. What's the expenditure actually? 780? 25,000 Rand. Okay, so I have expenditure of 25,000 Rand actually incurred in the year of assessment in the production of income. I have to rent this asset to do what? Is it closely connected to my business? Yes, to produce my income. Does this make sense? So therefore, you will have a deduction of 25,000 Rand. But what's my challenge with this 25,000 Rand? It includes three things. 1, repayment. 2, finance cost. And 3, what? VAT. Can I claim my repayments as a deduction in the production of income? Yes. Can I claim my finance as a deduction in my production of income? Yes. Right? Can I claim my VAT as a deduction in the production of income? No, because I've already claimed that back on day number 1. Make sense? Okay, so therefore I need to remove VAT from this transaction. How do I remove VAT from the transaction? I go back to day number 1, 780 times 14%. Anyone with a calculator? 780 times 14%. What do you guys get there? 109,200. Okay, so this 25,000 Rand I will pay over how many months? I'll pay over 36 months, so therefore I can spread this VAT over how many months? 36 months, and that will be 109, 200 divided by 36, which gives us how much? 3033. So therefore that will be your section 11A deduction. Guys, does this make sense? I know it wasn't part of the required, but I just wanted to reinforce this. Okay, the year end is December, but I'm just saying this is a monthly amount. So you'll multiply it depending on which year. Because remember, I was dealing with it from the 1st of April 2016. So in that year, you'll say times, not even times 12. It will be times 9 in the first one, times 12 in the second one, times, I don't know, is it 9 in that year, and then times 3, whatever it is. Okay, guys can figure it out. Is that cool? So in this current year, it ran from the 1st of Jan up until the 1st of April, which is 3 months. So our deduction for this 3 months will be that amount. Your deduction for that period will be that amount. Okay, now, after the 1st of April, terms change. The terms have changed. I'm no longer paying 25,000 Rand. How much am I paying? I'm now paying 3,000. Okay, guys, I had slightly adjusted the question to include VAT just for the purposes of this. Does that make sense? But the question itself says amounts exclude VAT, if I'm not mistaken. I need you guys to understand that, right? I just slightly amended this question to include VAT just to show you that part of that calculation. Is that cool? So I'll now revert back to all amounts exclude VAT. So all amounts exclude VAT, 3,000 Rand a month is what I will pay from the 1st of April up until the 31st of December. How many months is that? Is it 8? No, it's 9. From the 1st of April, so that should be 9 months. Okay, so therefore, 27,000 Rand will be still claimed as a Section 11A deduction. Because you're still paying rent, but you're no longer paying 25, you're now paying what? 3,000 Rands a month. Okay, so that said, let's look at the lease that has been abandoned. So look at page what? 34 in your handwritten notes? Was it 34, 33? 34. Abandoned lease. Page 34. So I have 3 types of abandoned leases. Number 1, I just walk away from that. Right, as the lessor, I just walk away from it. Number 2, right, I sell it for less than the nominal value. Sorry, less than the market value at a nominal value. And number 3 is I continue collecting rent, but at a nominal value as well. Okay, so we're looking at option number 3 here. So if you're looking at the 3 options in your handwritten notes, I'm looking at option number 3. Okay, so what is nominal rent? So that's your starting point. What is nominal rent? What is nominal rent? Nominal rent is when your annual rental, right? So nominal rent is when your annual rent is less than 10% of the market value of your asset. Does this make sense? Okay. Annual rent is when, nominal rent is when your annual rent is less than 10% of your market value. What's my annual rent? 3,000. Multiply that by 12, which gives me what? 36,000 Rand. So now I need to look for a market value. So if I'm not given a market value, right, there's a formula that I've given you there where you take the cost to the lessor, right, and you depreciate it using reducing balance depreciation, right? Okay, and your reducing balance is at 20%. I did ask you to put that in last week. Okay, so what is the cost of this asset to the lessor? What's the cost of the asset to the lessor? 780. So I will say 780. Multiply that by 0.8. That's the depreciation. Right, I've removed 20%. Reducing balance, 0.8 again. Reducing balance, 0.8, because this was a 36-month contract. Does that make sense? Okay. So therefore, 780 times 0.8 times 0.8 times 0.8 gives me the market value of this asset, which is equal to how much? 390? 99360. So compare that with 10%. 10% therefore is 39,936. My market value is 399. 10% of my market value is 39. My annual rent is 36. Therefore, my annual rent is less than 10% of this asset. If that is the case, therefore, right, we are what? Paying nominal rental. And if you're paying nominal rental, then this is what we call an abandoned lease. So what are the implications if it's an abandoned lease? Number one, you will have a recoupment which is equal to the market value of your asset. Right? So therefore, included into taxable income will be 399, 360. That will be your recoupment into taxable income because it's an abandoned lease. Okay, and thereafter, you're going to depreciate this deemed asset. All right, and you'll depreciate it over the remaining life, which is 2 years. So therefore, you'll say 399, 360, divide that by 2, multiply that by n over 12, and that will be the depreciation of this deemed asset. Yes, you're still paying rent, but SARS views this transaction as an abandoned lease. So therefore, you have gained 399,000 Rand. That 399,000 Rand, you will be allowed to claim as wear and tear. Make sense? Okay, cool. Any questions? Okay, let's quickly wrap up this question. Right, current factory building was erected at a cost of 5.5 million Rand, brought into use in 2017. 25% of the floor space is used as admin buildings. 5.5 million Rand factory building. Multiply that by what? 75%? Yes, no? I'm just trying to get you to think about that 25%. Times 55% part of? It's not part of because you own the entire thing. You're just using a portion of it for other things. All right, correct. So if you use it mainly for manufacturing purposes, then you're allowed to claim that 5% as a deduction. So if this property was being used 45% for manufacturing, 55% for other purposes, then you cannot qualify for that manufacturing claim. It needs to be used mainly for. However, now you're not going to lose that because if it's admin, more than 50%, then you just claim the admin one. So. Okay, previously when your admin buildings could not be depreciated, that's when you lost out. But it's really a redundant question now. Because either way, you'll still claim an allowance. Unless if it's second-hand. If it's second-hand, then you cannot claim. You guys remember that. All right, disposal of assets. I honestly do not want to look at them again. Okay, because I think we've done them quite a few times. So, we've got a company that paid 800,000 to an ex-employee who left the company, restrained him for the next 5 years. 800,000, divide that by how many years? 5 years. Okay, guys, please do not worry about provisional taxes. That should be test 3. So I know there's a big provisional tax calculation there. Okay, guys, so we've got the founder of a business, right? He's living a life of fortune, right? He sold his shares in this business 5 years ago. Since the sale of shares, he receives an annual amount of 2.5 million rand. Annual payment will be paid for the rest of his life. Okay, so we need to advise this person, will they be taxed or not taxed on the 2.5 million rand? Actually, not the sorry, we're looking at the company side, not the employee side. So let's look at the employee side. Actually, we can look at both. Look at the employee side. What is this? Fixed, repetitive. Okay, actually, before we even get to fixed repetitive payment, total amount. Is this a total amount? Cash or otherwise? Received by accrue to in the year of assessment, capital or revenue? Capital revenue. Okay, is this his business? Does he buy and sell shares? Right? Was this a once-off fortuitous transaction? Once-off fortuitous transaction, right? Will it ever happen again? Was it a scheme of profit making? Right? You will see that this potentially is capital in nature. He's selling his tree and not his fruit. His shares are his tree, right? So therefore, this amount in his hands will be capital in nature, right? But again, remember, we deal with 3 types of income. Gross income definition, and then what? Specific inclusion. What specific inclusion are you thinking of here? Annual, repetitive payment, chargeable against someone. So what is this? Annuity. Annuity specifically included into taxable income. Is that cool? So therefore, this guy will be taxed on that amount every year. Cool? So let's look at the company now. Looking at the company, how many types of deduction do we have? 3 types of deductions: general, specific, and prohibited. We can only claim how many? 1, Section 23B. Make sense? Okay. So, which specific are you thinking of here? Annuity, Section 11M. But when can I claim Section 11M? Old age, ill health, death, any of those situations? No. So can we claim Section 11M? No. What section can I consider? Expenditure, actually incurred in the year of assessment, in the production of income. Will paying this guy increase our sales, by the way? Right? It's not going to increase our sales. Think about it. I am teaching you, right? So you will pay the fees. Make sense? But whatever happens with the shareholders in the background, will it increase sales here? No. Make sense? So that is not in the production of income. Number 2, is it capital or revenue in nature? Does it deal with the operations of the business, or does it deal with the structure of the business? Operations is me teaching salary. Structure is the ownership of the business. Operations or structure? Structure. Structure relates to what? Capital or revenue? Capital. So that amount cannot be claimed as a deduction by the company that is paying it. Does that make sense? Okay, cool. The last thing that I'll look at and then give you a break is just these 2 transactions here. The other 2 transactions I'm not going to look at. I'll look at these 2 transactions. We come back, we look at question 3, and slightly running out of time. It's all good. So on the 1st of Jan, they received a machine, right? This was a donation from Jake. Can I slightly change this? It's a machine used in the process of manufacture. Right, so they received it as a donation. He carries on a business as a sole proprietor. So he gave his company an asset. Okay, so can we claim, obviously it's a second-hand asset, Manufacturing, can we claim 20% on it? Manufacturing asset, 20%, because now the business owns the asset, right? You can depreciate if you own the asset. 20%? Yes? No? Yes? No? Yes? No? Do we have a cost? We do not have a cost. Cost is when I buy the asset. I did not buy the asset, I received the asset. So if I do not have a cost, right, then I cannot use section 12C, section 12 capital E. I can only use section 11 small e, right? 11 small e uses the value of your asset, right? And therefore the value of our asset in this case will be the market value on the date we receive this asset. Even if it's a new manufacturing asset, as long as we did not buy that asset, we will take the market value, divide that by rate, multiply that by n over 12 because we do not have a cost. Is that cool? Okay, no cost, cannot claim that deduction. So you only claim section 11 small e. All right, and then the last one. So we've got a company experiencing financial problems. They reached a compromise in accordance with the persons that owed the money wrote off the loan of 100,000 and interest of 10,000 rand. So you write off the 100,000 and he wrote off the 10,000 rand interest. Okay, so I've got two parties to this transaction. Party number one is the party that gave the loan, right? And party number two is the one that received the loan. Guys comfortable with this? Okay, so person that gave away the loan, in his books, debit, debtor, right? This is the original transaction. Debit debtor, 100,000 rand. Credit, what? Bank, 100,000 rand. Right? The company that received used the funds to finance their operational expenses. Okay, so it means that they gave them cash. And then they chose what to do with the cash. Does this make sense? Okay, cool. So that's your original transaction. A little while later, debit, debtor, credit, what? Interest. 10,000 rand. So therefore, my total balance is equal to how much? 110. Cool. Now, I want to look at the guy that gave the loan. What are the implications for this guy? Okay, I think one thing that I just didn't read there is the fact that they're connected persons. Right, so I am forgiving a debt. What section am I thinking of here? Bad debts, right? I am forgiving a debt, bad debts, because I'll never collect this anymore. Bad debt, writing it off. My entry here will be to debit an expense and credit what? Bad debts. Question is, can I claim that as a bad debt deduction? 110,000 rand, 110,000 rand there. So go to page 11, I think, 11, 12 of your handwritten notes, because that deals with your bad debts. That deals with your bad debts. Okay, thinking of this in context, right? Bad debt. Number one, requirement for bad debt needs to be due to the taxpayer. What page is it? 11, 12. Okay. Needs to be due to the taxpayer. Everyone comfortable with that? Number two, It needs to have been what? Included in what? Taxable income. Was this amount ever included in taxable income? Yes or no? No. And yes. 10,000 Rand was included into taxable income. Credit interest, total amount in cash or otherwise, received by accrued in the year of assessment, tree or fruit. Fruit. This is the fruit. So this was included in taxable income. Make sense? All right. So 10,000 Rand was included into taxable income. Right? Can you prove that it has gone bad? Yes. Right? And due to the taxpayer in the current year. So therefore, 10,000 Rand will be claimed as a Section 11I deduction. Make sense? How you guys? This is pure bad debts, guys. Nothing shocking here. Cool? So, the other one, can I claim it as a bad debt? No. 100,000, not a bad debt, not a bad debt. Never included into taxable income, right? So therefore, nothing will be deducted there. So if nothing is deducted there, look at slightly at the bottom there of your notes. What do I do if I cannot claim it as a bad debt? If I cannot claim it as a bad debt, what do I do? Can claim it as a capital loss. Can you guys see that? Right? If you cannot claim it as a bad debt, you claim it as a capital loss. Proceeds equal to 0. Collected nothing. Base cost is equal to how much? 100,000 Rand. So therefore, we have a capital loss of 100,000 Rand. Does this make sense? We've got a capital loss of 100,000 Rand. Does this make sense? However, we're dealing with a what? Connected person. If we're dealing with a connected person, what are the requirements? We need to disregard any capital losses, except if in terms of Section 19 or paragraph 12, capital A. Right, so we need to see whether we will apply Section 19 and paragraph 12A. Because if paragraph 12A or Section 19 is applied, then we will claim this as a capital loss. So what I'm going to do, bringing it into context, asset number 1 will have a capital loss of how much? 100. Asset number 2, whatever it is, right? Therefore, this amount can reduce my what? Aggregate gains. If not, if I'm not applying Section 19 or if I'm not applying paragraph 12A, then I cannot use that 100,000 Rand in my capital gains tax calculation. Does this make sense? Okay, cool. Right, and then let's just go and look at this guy here. Right, debit bank, credit, creditor, 100,000 Rand, 100,000 Rand. So this amount here is what we call a what? That's your loan or your debt. Any questions there? It's fine, right? Okay, let's move on to the next concept. Next concept, debit what? Expenses, which is your interest. And then we will credit the bank 10,000 Rand. Three types of deductions: specific, general, or prohibited. Which one am I going for here? It's not specific, so therefore I will go general. Expenditure actually incurred in the year of assessment in the production of income. Therefore, 10,000 Rand I will claim as an interest deduction. Okay, technically section 24J, right? But you guys understand this. Okay, or you'll understand this in test 3. Cool. Guys, comfortable? All right. Any questions so far? So I can claim that as a deduction. All right. And then what happens? Someone writes off this debt. So debit, creditors. Sorry, wasn't supposed to say bank there. Creditors, sorry. It happens. Debit creditors, 110,000 Rand. Credit what? Is this an income? From an accounting perspective, yes. If a debt prescribes in accounting, it's income. Is it not? It's a gain. Think about it. Your resources have increased. If your resources increase, right, what does that mean? It's a gain. What's a gain from an accounting perspective? Income. It's included in your income statement. Are you guys comfortable with this? So from an accounting perspective, that 110,000 Rand goes into your income statement. Guys have done debt prescription in accounting, right? When a debt prescribes. Okay, comfortable? All right, now let's look at it from a tax perspective. From a tax perspective, I have two sections I can consider. Section 19, paragraph 12A. Section 19, number 1. Right? Number 1, do we have a debt benefit? Do we have a debt benefit? Right? A debt benefit arises when we have a concession. Offer what? Needs to be a concession of your debt. Sorry. Right? This arises from an event, and that's the event there. And that concession leads to that debt benefit. So question here, was this debt written off? But how much of it is a debt? How much of this is a debt? From a tax perspective, only 100,000 Rand. Debt excludes interest. That interest is not debt from a section 19 perspective. Guys, go to the last 2 pages in your handwritten notes, and you'll see exactly what I'm talking about. Section 19. Why does that look like the old version? Okay, there we go. The second last page. Literally the second last page, guys. Okay, so question, do we have a debt benefit? Yes. In respect of a debt, right? Not interest. Does that make sense? In respect of your debt. And in our case, 100,000 Rand is our debt. The 10,000 Rand interest, that's separate. Okay. All right, so concession, right, of a debt, we're comfortable with that. Okay. So debt benefit arises. Okay, now the next question is, what did we use this 100,000 Rand for? What was the 100,000 Rand used for? So if you go back to the question, you'll see that the 100,000 Rand was used to fund operational expenditure in terms of Section 11A. So therefore, this debt here was used to fund expenditure. All right, number 3, it should not be donations tax, It is not estate duty calculation. It is not a fringe benefit calculation. So donations, estate, fringe benefit. What else am I leaving out here? Group of companies. And where you're looking at dormant company. Okay, technically all I'm saying is this a commercial transaction? Now, let's think about why companies do debt restructuring, right? Connected parties do debt restructuring. If one division is struggling financially, right, is it not good for the group to write off that debt so that they can give them a chance of surviving, right? Okay, so therefore, this is viewed as a commercial transaction. If it's viewed as a commercial transaction, therefore Section 19 applies. So if Section 19 applies, we're going to use Section 19.5, and Section 19.5 says if you used that debt to fund expenditure, your debt benefit will equal to a what? Recoupment. So I will include the full 100,000 Rand into my taxable income calculation. So Section 19 therefore applies. Does that make sense? So if Section 19 applies, on the other side, what it means on the other side is, yes, Section 19 applies. Although this is a connected person, I still can do this in my taxable income, taxable gain calculation. Okay, but Section 19 applies there. All right, and then we've got the 10,000 Rand interest. The 10,000 Rand interest, let's look at how I benefited on the 10,000. Claimed a deduction on the 10,000 Rand. So when it is written off, I will include it into taxable income again. So that will be in terms of Section 8.4a. Anytime you benefit, right, SARS always wants that benefit back. The recoupment into taxable income. Now, this is one of the most complex transactions that you'll get in test 2. If you can understand it, then you're good. If you don't understand it, we've got problems. Okay, but guys, can you see? Person that is given that gave the loan, there's a debtor that they raise, bad debts only on the interest. Make sense? The other 100,000 Rand will be a capital loss, right? So for your connected person, you'll disregard this capital loss. Unless it's in terms of Section 19. And in this case, Section 19 applies, so I will not disregard that capital loss. All right, and then looking at the person that receives that loan, debit bank, credit creditors. Okay, debit expense, credit, your creditors there. Section 19 applies because there's a debt benefit used to fund expenditure. It's a commercial transaction. Therefore, recoupment will be equal to that 100,000 Rand. And then for your interest, you claimed a deduction on that interest. When it's written off, you will recoup it into your taxable income calculation. All right. Okay, so if you think about here, when you receive it, debit bank, credit creditors. Now when you then debited maybe salaries, 100,000, credit your what? Bank, 100,000. How did you deal with your salaries? Salaries you did claim as a deduction. Hence, can you see this 100,000 Rand here is therefore going to be cancelled by that recoupment of 100,000 Rand there. Yes. Cool. 10 minutes. 15-minute break, guys. Unfortunately, still need to cover 2 questions, 3 questions.